In today's video, I want to show you an amazing indicator that is built based on Heikin Ashi candles. Make sure you watch this video until the end because I'm going to teach you a very accurate trading strategy that is highly profitable. Alright, if you're familiar with candlestick chart, so you know that sometimes the ups and downs of trends are really confusing. For example, in an upside move, you may see many bearish candles as there are bullish ones, or in a downside move, you may see many bullish candles as there are bearish ones. The reason is that candlestick charts show the price as it is, and they tell you exactly how much the price has changed in a period of time. This is not a bad thing, and for trade entries or exits plays an important role, but as I said, this causes some noises on the price chart, and this could be a little confusing, especially for beginners. But on the other hand, Heikin Ashi charts try to solve this problem by using data from two periods, and because of the way that Heikin Ashi candles are calculated, Heikin Ashi chart shows a smoother price movement on the price chart, and you can see that we have green candles following each other in an advancing of the price and red candles following each other in declining of the price. Heikin Ashi chart is an excellent price chart that can filter the noises and show a smoother movement of the price on the chart, and this makes trend visualization very easy, but this comes with a cost of losing the exact movement of the price. When a Heikin Ashi candle opens, the opening price is not the current price of the market, but it's an average of the opening and closing price of the previous candle, and when it closes, the closing price is not the final trading price in that time period or anything close to the current price of the market, but it's an average price. And because of this, in practice, Heikin Ashi candles can be misleading, because when you want to enter a trade or exit a trade, they don't represent the actual price of the market unless you are a midterm trader or long-term trader, which in this case you don't care about the exact price. Now in this video, I want to introduce an amazing indicator that overlays Heikin Ashi candles on our candlestick chart. So we will have both of them together, and it helps us to effectively identify trends without being interrupted by these noises. To add this wonderful indicator to our chart, here we click on indicators and we search smoothed Heikin Ashi candles. This one, smoothed Heikin Ashi candles version 1, which is written by someone named Jack VMK. Alright, this is the indicator, and as you can see, it's overlaid on the price chart in the form of consecutive red and green Heikin Ashi candles. These are smoothed Heikin Ashi candles with length of 10 by default. If you increase the length, the degree of the smoothness will be increased. Actually, they will be placed further away from the price action. For markets that have higher degree of volatility like crypto, or in times that the market condition is volatile, you may need to increase the length of this indicator. As you can see in this part, which the market is in a downtrend, we have consecutive red Heikin Ashi candles with the price moving below the Heikin Ashi candles, and in this part, which the market is in an uptrend, we have consecutive green Heikin Ashi candles with the price moving above the Heikin Ashi candles. This smoothed Heikin Ashi indicator has a similar behavior like moving averages, and the crossing of the price above or below the Heikin Ashi candle can signal possible changes in the direction of the market. But by relying only on price crossovers, you may encounter many false signals just like moving averages, and the most effective way is also applying price action analysis. For example, here, when the price went above the smoothed Heikin Ashi candles, we don't instantly conclude that an uptrend started, because this can be just a false signal, or the market may go to a trading range. So we wait to see if the price can break this resistance level or not. When it's broken, we have more probability that a reversal is happening and direction of the market is turning to an uptrend. And you can see that from here, the price stayed above the smoothed Heikin Ashi candles. Or for another example here, you can see that the price went below the Heikin Ashi candles, but we don't instantly conclude that a downtrend started, and we wait to see if the price can break the support level or not. But you can see that it couldn't, and the price went to a trading range, and finally an upside breakout here, and then continuation of the prior uptrend. Please pay attention that in trading we are talking about probabilities. We could have breaking of this level, but then after that having this situation. So it's all about assessing probabilities to see if there is more probability or lower probability. And please pay attention that in times that we have deeper pullbacks during trends, we can have price crossings in the pullbacks. For example, here during this uptrend, you can see that on the pullbacks, the price goes below the Heikin Ashi candles and then again advances after that. By the help of the method that I taught you, you can evaluate these kinds of movements based on price action to better understand if there is more probability for reversal or continuation of the price. We know that when the price couldn't break this support level and then turned back above the Heikin Ashi candle, it's a sign that the price is gonna advance. If the asset you're trading is always like this, you may consider increasing of the length for this smoothed Heikin Ashi candles. Alright, now let me show you how you can trade based on this smoothed Heikin Ashi candles that we have on our price chart. Until now, we know that when the Heikin Ashi candles are red and the price is fluctuating below the Heikin Ashi candles, we are in a downtrend. In this situation, when the price touches the Heikin Ashi candles or even goes above that, it shows that possibly a pullback is forming on the price chart. And when the price starts falling from the Heikin Ashi candles, we can enter a short position. You can use price action analysis to know when the price is starting to decline, or you can also use some indicators like RSI, this one, Relative Strength Index, which will help us to know the end of the pullbacks. When the price touches the Heikin Ashi candles, it's usually the case that RSI is above its moving average line. And when RSI crosses back down its moving average line, it's a sell signal and we can enter a short position. When the crossings are happening, both of RSI line and its moving average line should be below 50. And on the other hand, when the Heikin Ashi candles are green and the price is above the Heikin Ashi candles, the trend is up, and in the situation, when the price touches the Heikin Ashi candles or even goes below that, it can be a sign that a pullback is forming on the price chart. And in this situation, usually RSI is below its moving average line. I mean, when the pullback is forming, we have RSI below its moving average line. And when RSI line crosses back above its moving average line, it's a buy signal. And both of RSI line and its moving average line should be above 50 when the crossing is happening. For example, we don't take a crossing like this. By the way, I have already explained that when this happens, it shows weakness in the prior uptrend and we must wait to see which way the market will break. So in practice, we don't enter any trade here in this situation. This is a trend following strategy and it doesn't work well when the market is not trending, and also in times that the trend is stopping just before going to a trading range or just before an instant reversal like what happened here. In these situations, we may encounter false signals like this one or this one. And this is common with all trend following strategies, and you need to properly manage these kinds of trades. There is no strategy with 100% guaranteed signals, and you must always manage your risk properly, otherwise you will send your account to zero in very short time. There is a risk management strategy that is called 1% rule, and it's a perfect choice for active trading. I have a complete guide on this. The link is also placed in the description of this video, and I highly recommend you to watch it because risk management is the most important factor in your trading success. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading.